This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Hey, buddy, just wanted to say thanks again for the awesome job you did Friday morning. That was great. Just started out our day perfectly and put a cap on our event. I just thought it was awesome, man. You did a great job. But even more than that, just appreciate your spirit in the room, man. Seemed like you're just more alive and just more enthusiastic than ever about things you're working on and things the family's doing. So I just want you to know I appreciate you, man. Travel safe.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Greetings, empowered investors, and hello from Medellin, Colombia. Today we've got a great show for you. We've got a returning guest, and that is none other than local Medellin resident, George Gammon. So I've been hanging out with him for the past several days. We took a monster walk yesterday and got some steps in. Talked about a lot of stuff. But here he is back on the show today. I think you'll really like what you hear. He has become a little bit less bearish on the housing market and the economy, I would say, but you can judge for yourself. He's usually pretty darn bearish, and sometimes we have our debates about that, but that's going to be a great show. So that'll be up for you in a moment. If you have registered for Empowered Investor Live, we look forward to seeing you in just over 2 weeks in beautiful Southern California. And if you have not, go to empoweredinvestorlive.com right now and get your tickets, empoweredinvestorlive.com. We're going to have a great event coming up. We've got Sharon Lechter, we've got Tom Wheelwright, we've got Mike Maloney, first-time speaker at our events, myself, of course. We're going to cover a lot of great fundamentals. We're going to talk about all the important stuff. And one of the new things that we're bringing to this event that we have not had at a prior Empowered Investor Live is a lot of stuff about lease options and about rent-to-own deals and sale leasebacks. So some more creative strategies you're really, really going to enjoy. We're also going to have some talk about hard money lending and how you can profit from that. A whole bunch of great stuff for you coming up at Empowered Investor Live in Southern California. And it's on the first weekend of April, so be there or be square, empoweredinvestorlive.com, and let's get to George Gammon. It is my pleasure to welcome back George Gammon. He's coming to us from long distance because we are both here in Medellin, Colombia, but we decided to record digitally and virtually, even though we're not too far apart. We're only a mile away. George, how you doing?
I'm doing fantastic. There's a lot going on. I knew going into 2025 that there would likely be some volatility, and that's pretty much what we've seen. In my videos, I've been saying that I've been creating content for about 5 years. I've been following macro since 2012, and outside of March of 2020, I don't know when we've had a time when there has been more uncertainty.
Yeah.
So a lot to talk about.
I would definitely agree with you. Things are very chaotic right now. They're very up in the air. A lot of businesses, especially home builders, I'd say reeling from the uncertainty because they just don't know what their cost structure is going to look like.
Tariffs, labor. We talked about that the other day. You can love the tariffs or you can hate them, but the bottom line is that if you're a business owner and a large majority of your inputs are imports, there's a time lag there. You can't just, if you got XYZ input, there's probably a reason why you're importing it, and it's either a much cheaper price or you just flat out cannot get it in the United States. Yep. And so I think a lot of people have this idea with the tariffs that, oh, well, that's no problem because they'll just buy from the United States. And a lot of times that's not an option. So over the mid to long term, it could be a net positive. We'll have to see how it plays out. I don't like the policy from an economic standpoint, but over the short term, it undoubtedly creates a lot of confusion. Even if you love the tariffs, the way they're being presented creates a lot of confusion because they literally change from minute to minute.
Yeah.
Sometimes day to day. Who knows what Trump or the administration is going to say about the tariffs on Canada or Mexico or China.
Yeah.
Yesterday, we went from 100% tariff or threatening 100% tariff on champagne to, oh, you did something I don't like. It's 200% now. I don't know what's going on. In fact, I was in St. Bart's talking to a lot of hedge fund managers, and I kind of asked them the same question about what they see in the global macro landscape, and they just kind of shake their head and laugh. And they just say, I have absolutely no idea.
Right. Yeah. Yeah. No, it's a really weird time. Do you think this will sort of settle down though into some like real economic policy? Trump will always be Trump, right? We know that, but are we going to settle on it's going to be 25% on Canada and Mexico, for example, and maybe it'll stick or who knows, right? But your thoughts?
If you go back to the last time he was in office, it was much more straightforward and much more of a plan and an execution of that game plan. Not precisely, but far more than the haphazard kind of bull in the china shop approach that we've seen throughout the first couple months of his second term. So what's going to be the MO moving forward? I don't know, because already he's quite a bit different than he was the first go around. I would assume that it will settle down and we will have maybe a more premeditated approach, maybe after 6 months or so, because if you just continue to do this, it's going to really disrupt markets. We see the stock market, the S&P 500 is already in correction territory, which is defined by just a 10% move down. And at the end of the day, Trump and Scott Bessent and all the people around him know that the United States economy is really heavily dependent upon asset prices, not just housing, which is your cup of tea, but also the S&P 500 due to 401k. And what's interesting too about today, and maybe more so before the S&P 500 came down by 10%, it wasn't just 401ks were dependent on the S&P 500 because you had so much concentration, because it was the S&P 500, but really that was all about the Mag 7. And the Mag 7 was really all about NVIDIA. Yeah. So what happened is, and I did a whiteboard on this, so I remember it very well, is we had DeepSeek come out. I don't know if you remember that.
I do. That was the thing that upset the whole market. That was only 4 weeks ago, 3 weeks ago.
Yeah, crushed NVIDIA. Yeah. And if you look at a chart of what NVIDIA and what the stock market has done and the NASDAQ since DeepSeek, it's just gone straight down. So I don't know if that was the driver of the whole move, but it seems like it was definitely the catalyst, and everything was priced to perfection. And in fact, it wasn't even priced to perfection. It was priced for better than that, because we saw NVIDIA come out just the other day with earnings and they blew it out of the water. They exceeded expectations by a large margin. And what happened to their share price? It got crushed. Yeah. It was down like 8% the next day. And so that just tells you how the stocks were priced, and that there was asymmetry to the downside. And I always say there's three things that go into every great investor. It doesn't matter whether they're investing in real estate or stocks or commodities, whatever it is. You have to be very, very good at managing risk. You have to have an edge, and you have to make asymmetric bets. But you want the asymmetry to the upside, not the downside. Right, of course. That's where we were with NVIDIA. Therefore, that's where we were with the Mag 7. Therefore, that's where we were with the S&P 500 and most people's 401k. So, this could be a buy the dip opportunity. I don't know. Right. Let's just assume for a moment that next week we start getting some clarity around Trump's economic policies, and he's a lot less haphazard. And then it turns out that he's really not doing a 25% tariff. At the end of the day, it's a 3% tariff and a 10% tariff on China. And that's pretty much it. Then, this is probably a buy the dip opportunity, assuming that we don't have a further deterioration in the economic data or a contraction in the economy, which we might have, but that takes us to the topic of interest rates.
Okay, well, wait, before we get there, I want to just ask you about a couple things you mentioned. First of all, what does priced to perfection mean? When you say that, what's that mean?
That means everything has to go perfectly in order for the price to be justified.
Okay.
So
right.
You have
so,
to.
So I see price to perfection in the forward-looking. Right. I get it.
Yeah. So if it's priced that earnings will be perfect and that the growth will never veer from a 70% trajectory or something like that. So if it's priced for perfection, then all you have to do is just get 65% growth. And you're still growing at a fantastic rate. But since the price was to perfection, the stock apps crashed.
Right. So when you take the NVIDIA example, I mean, it came out with great earnings, but the earnings are backward looking, and the threat of DeepSeek or other AI models, beating them and not needing their chips is forward looking, right? So, so
let's say expectations were at a 0, right? Let's just say that's kind of the line where market expectations were for their earnings. They came out with a 5. They came out with a 5. But the stock still absolutely tanked because it was so overpriced and all the inputs and variables that you're talking about. So in order for the stock just to go up or remain flat, if expectations were a 0, we would have had to have seen a 10. And the probability of that, even for an NVIDIA, a very high growth company, is incredibly low. But that's when you have FOMO, when you have hysteria, and you have this market mania that we see around AI and NVIDIA and everything that goes into it. And it doesn't mean that AI is not the future. It definitely is. But that doesn't mean that currently the stocks are priced accordingly for what they're going to produce, let's just say in the next 2 to 3 years, especially when you have the unknown of DeepSeek and that potentially disrupting, let's say, the business model of NVIDIA, which again, why is NVIDIA so important? Because it's such a high concentration of the S&P 500.
Yeah, right. It's just a huge part of it. So before we get to interest rates, and I do want to ask you about that, I do want to ask you just your general thoughts about artificial intelligence. I mean, we've all been amazed at the capabilities. Do you think we should really be worried about the threats of it? Are you really optimistic about it? What does George think about AI?
I think it'll be exactly like the internet.
Yeah.
From a standpoint of, how did that turn out? It makes productive people more productive. Like today I was using Google and I was using Perplexity, which is an AI app. And you still have to really guide it quite a bit. It's not really thinking on its own. And another thing too that we have to remember is it's very similar to accounting or data entry, where it's what we, dog crap in, dog crap out. And over the weekend, I was talking to a guy that's in the AI space. He's got an AI company and it's based on nutrition. And I said, how does that work? Because if we had AI back in the day when egg yolks were persona non grata, the AI would tell you don't eat egg yolks.
Right. But eggs are one of the most perfect foods in nature.
And now we know that was kind of fake news.
Right.
And we've kind of evolved our thinking since then. You see what I'm saying? So at the end of the day, I don't know that if we would have had AI back in the 1980s, let's say, and egg yolks were, you don't want to touch it with a 10-foot pole. If we would have had AI back then, would AI have told us that egg yolks are actually healthy for you?
Right.
I don't know. So, and he's like, that actually is quite a problem. He says, hopefully with the AI, we'll just evolve our thinking at a much faster pace because you got an additional brain, you've got additional thinking power, that AI to assist whatever the human beings are doing. So I think there's a lot of upside there, but like anything else, there's a lot of downside as well. Before emails, we never had Nigerian prince scams. Right. But I don't know if you throw the baby out with the bathwater, right? So that is one of my big concerns with AI, especially with you and I being in the content arena, is I think in the very near future, it's going to be extremely easy to replicate Jason Hartman.
Oh, yeah. It already is. We should mention George has his content syndicated now in other languages. He's using AI to basically translate everything he says into other languages, and the lips move, but it's definitely not perfect. We were looking at it the other night together.
Yeah, but it's good enough. I mean, those channels are gaining subscribers and they're gaining views, and it's incredibly easy to do. But that's still George Gammon.
Right.
I think my concern, and I think this is going to be a reality, is people are going to be able to do a George Gammon video without
Yeah.
George Gammon,
Right.
and going to be
Yeah.
able to do a Jason Hartman video without Jason Hartman.
Yeah. The
And
deep fake.
there's going to be a Jason Hartman video that people are going to watch where Jason Hartman is saying, whatever you do, don't buy real estate and don't buy in a linear market and don't use, debt because we're going to have deflate and all these things.
Yeah. Right.
And the dollar is going to crash. And all these things would be the opposite of what
Yeah.
you would say, but the people don't know because it's you. It looks just like you. It sounds exactly like you. And that's going to be a really big problem. And I don't know how YouTube and these other platforms are going to tackle it. So initially, I'm not worried about the Terminator scenario. I'm more so worried about the scammers being able to leverage that, very similar to the way the Nigerian guys did with email when we first had it.
Yeah, and I know you've had a lot of complaints about that over the years about people putting comments in your YouTube threads, and I get that too, with crypto scams, and it's just unbelievable,
I mean, I've had my Twitter account hacked twice, and the first time they hacked it, they went out there and they did a post as George Gammon, and it's got the blue check mark. It's my account,
Yeah.
And they said, "Oh, we're doing this charity deal where we're selling MacBooks for $600. So all you have to do is DM me and I'll give you the account to send the $600 to, and I'll send you the MacBook, and all the proceeds or all $600 goes to charity." And they presented that as George Gammon. Well, of course, that was a scammer. And yet all these people send him the $600, but obviously they didn't get the MacBook. And,
well, I was actually going to complain about that. At dinner the other night with you, I was going to mention that to you. I never got my MacBook. So you still owe me.
Yeah, well, a lot of people got ripped off. And when I got control of my account, I went and counted how many people in my DMs actually sent them the money. And they scammed people out of about $50,000.
Wow.
So it was, and then the people think that it's you, and it's you got to go through all those and apologize and let them know that it was actually a scammer and it wasn't you. And, I mean, it's really a nightmare. And I think that's going to get potentially a lot worse with AI. And what's weird is the platforms really don't seem to,
they don't care. Yeah.
Like with Twitter, that it was obvious that was a scam. And the guy had the scam up and control over my account for probably 2 weeks. So again, how good is their AI when they can't even tell that's a scammer? Or maybe they don't care. I don't know.
I think largely they don't care because these platforms they're just whores for engagement. And if engagement is happening, that means their ads are being seen more, and that's all they care about. They don't.
I think that's why they don't eliminate the bots from the chat and the YouTube videos.
Oh yeah,
crypto and whatnot. Because I mean, seriously, people like to think that the smartest people on the planet Earth are all working in Silicon Valley.
Yeah, they're not.
They're all working for Google. Well, if you have all these 150 IQ guys and gals working, computer engineers and scientists and whatnot, you're telling me that they can't figure out a way to stop crypto scams proliferating in the comments of the YouTube videos? I mean, I'm a hard sell on that one.
It's easy. It's easy to stop that. Of course they can. But they don't want to. Have you ever wondered how the top real estate investors consistently find the best deals before anybody else? Well, listen up, because this can transform how you invest. I'm excited to share something that's revolutionizing the real estate game. It's called Connected Investors. This is a really cool platform that gives you access to all of the property records nationwide. Truly amazing. It's not just a platform, though. It's a secret weapon. It does a whole bunch of things. Besides the property data, it's a social network as well. It's built by successful real estate investors for real estate investors. Find off-market deals instantly, access accurate ownership contact info, make smart data-driven decisions, and secure funding for your deals from a vast network of private and hard money lenders. Whether you're a beginner or a pro, Connected Investors is your go-to tool for smarter, faster, and more efficient investing. Try a 7-day free trial at jasonhartman.com/connected. Again, that's jasonhartman.com/connected. And let us know how much you love this software. So George, let's talk about interest rates. I mean, this is huge for real estate and, every other business that's borrowing, of course. Where do you think they're going? The inflationary pressures have eased a bit. Interestingly, we always have agreed that the CPI is the CP lie, I call it. It's understating inflation. But the last couple of months, I've been seeing some articles that it might be overstating inflation. Can you imagine what's going on with that?
Yeah, I think it all depends on the basket of goods, but I always kind of lean toward it's probably understates it. But I always look at it just because I think it does indicate the trend.
Mm-hmm.
So you can argue, we topped out at 9.1% in the summer of 2022. And you could argue that real inflation was maybe 15%. And I think you'd have a very valid argument.
Back then, I would agree with you for sure. Yeah.
Yeah. And then it goes down to 2.4. So from 9.1 to 2.4. So did it get all the way down to 2.4? Maybe, maybe not. But I think that the trend was definitely down. I mean, the consumer prices in the United States, although they still are going up, they're not going up to the degree to which they were in 21 and 2022. So I just kind of use that as a proxy for whether the trend is inflationary or disinflationary or deflationary. And right now it's disinflationary. I mean, that's what the long end of the curve is telling you. The 10-year treasury went from 4.8% all the way down to maybe 4.25 where it is today. And the long end of the curve is all about growth and inflation expectations. And now we actually have the curve re-invert. I mean, it was inverted for like 2 years, which is not a good sign about the underlying economy from a standpoint of growth. And then we had it uninvert. And usually when it uninverts, that's kind of when the stuff hits the fan, so to speak, if you look at past cycles. And it usually uninverts as a result of the Fed dropping the front end of the curve. And
so when the yield curve inverts and investors are getting a lower return for the long-term investment, right?
Yeah.
That's the inverted curve. That's a sign, or it's been a successful sign that a recession is coming. How long does that usually take? Like, what's the lag time on that usually?
I mean, it can be, I don't have the chart right in front of me, but it's like 9 months to 2 years. I think GFC was like 2 years, something like that. A lot of experts and market commentators, I don't think have really gone through and analyzed why the curve inverts or why did interest rates go down at the long end of the curve that usually precedes an economic contraction. If you actually think about how the balance sheet works, it makes a lot of sense. So if you're a bank and you're in the Eurodollar system or outside the United States, because really the treasury market, we have to remember, is the bond market for the world. So it's not just about growth and inflation expectations in the United States. It's also growth and inflation expectations in Europe, China, Japan, etc.
Everywhere.
So when you see these global dealer banks or pension funds or hedge funds, what have you, they're the ones that are really the players in the treasury market. So they've got options with their balance sheet. They can increase the size of their balance sheet by lending money at, let's just say, 6% into the real economy, but they have higher risk. I'm just throwing numbers out for the sake of the example. Or they can lend at 4.3% to the US government and get a 10-year treasury, but they're going to get a lower yield, but there's a lot less risk. So what happens is when risk in the global economy goes up, then usually that incentivizes, that changes the incentive structure for those banks with the balance sheet to lean more towards treasuries, right? Because then the risk reward makes more sense over here because you have the high risk.
So the money flows there pushing the yields up, right?
No, they're pushing the yields down.
Oh, sorry, pushing the yields down because there's more money flowing. Yeah, got it.
That's correct. And if risk is going down, you're like, oh my gosh, the global economy's on fire. It's great.
It moves away from the treasuries and then the yields go up because they have to offer more to get people to buy them. Okay, so the long and the short part then, why the inversion? You were talking about most commentators aren't really analyzing why the inversion occurs.
So we just went over why those big money players buy the long end of the curve when they see economic storm clouds. It's because they're just utilizing that balance sheet capacity to the best of their ability based on the risk and reward. And these people always have insider information. And I'm not saying it's illegal insider information.
Yeah, it's just they're just in that world. So
yeah, Warren Buffett, as an example, he talks to more global CEOs than you and I do. So he's going to have information as to what's happening, with their sales, with their profit margins, with their hiring, and he's going to have access to that in bankers all around the world. So when you see Warren Buffett at an all-time high in cash, and not just in nominal terms, but as a percentage of his overall portfolio, last time I checked a couple weeks ago, he was at over 330 billion in cash. And why? Well,
Yeah.
that's because he
He
sees
doesn't. Yeah.
he's get the insider information,
Right.
and he knows why all of these banks and all of these financial institutions are taking that balance sheet capacity and allocating it toward the long end of the curve instead of investing out at a better return into the real economy. And so then what happens is the curve, so let's say the long end's my right hand here, and it's probably reverse the way people are looking at it.
Yeah.
But the long end goes down because of the dynamic we were referring to. And then the Fed is always behind the curve, no pun intended. And then they come down like this, and then they come down, 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 down because they're responding to an economic contraction. They're not preventing an economic contraction. And then that brings the front end down, and then that brings the long end down slightly, but nowhere near as much as the front end of the curve. And that's where you usually get that steepener where the curve uninverts. And then usually that's when the stuff hits the fan. It's not when the Fed starts dropping right away. It's usually, 6, 8, 9 months after they start dropping because they're trying to get ahead of an economic contraction, but they're always late to the party because all their data is in the rearview mirror.
Right. Very interesting. Okay, so where does that leave us on mortgage rate predictions, if you have them?
I would say lower with the caveat. It depends on what they do with quantitative tightening.
Yeah.
Because mortgage-backed securities are different than treasuries from a standpoint of the incentive that we were talking about with the balance sheet utilization from these financial institutions. So if the Fed is selling mortgage-backed securities or letting them roll off their balance sheet, let's say they're doing that as they do QT more so than with the treasuries on their balance sheet, well, that means the market is going to have to absorb those mortgage-backed securities. And that isn't just about inflation and growth. Then you have a risk premium in there as well. So, I mean, you would know better than I would, but I think that the delta between mortgage rates and the 10-year treasury is pretty high right now. And I don't know if it's an all-time high, but it's pretty high. And so just because the 10-year treasury comes down, it doesn't necessarily mean the mortgages should come down, but it doesn't mean that they have to come down because the Fed could be doing QT and selling mortgage-backed securities. So there's more supply. The market has to pick that up, and they want a much higher risk premium than the Fed wants, which is zero. The Fed wants zero. The market actually demands, let's just say 100 basis points. So you could see that play out. But my expectation for mortgage rates, if the 10-year treasury were to go to, let's say 3%, I would expect definitely mortgage rates to come down, but they might not come down as much.
Yeah. I was talking on your channel when you interviewed me the other day. And, it's usually me talking about like where are housing prices going, where are housing rents going, supply, demand, et cetera. I'd love to just get your thoughts on that.
My base case would be probably flat, nominal, and, down, what would that be? 2-3% real. You include inflation, assuming.
So you're saying adjusted for inflation, that's an appreciation number you just gave?
I would say the prices would go down in real terms by a couple percent, maybe flat in nominal terms. That's if we stay where we are today. Now, if we go into a recession, and I would kind of define that by the unemployment rate really spiking. We've seen the unemployment rate go from 3.4 up to 4.2 and then back to 4, and now it's back up to 4.1. But I'm talking about a real spike when it goes straight up to 5.5 or 6, which is usually what we see in kind of like the middle part of a recession. And that really impacts demand. It impacts the economy to a large degree. And I think that would really move the needle on the supply side of the equation. And I don't know that if we're going into a recession, that demand would pick up significantly, even though prices are coming down, because people are losing their job and they're very concerned about not just the economy, but assets with the S&P 500 and housing. So you might see a bit of a decline. If that happens, I'd say maybe, I don't know, 5% nominal, maybe 6 or 7% real. And then you have to see what happens on the other side of that, the economic distortions that are created by the government's response to the recession. That could take prices lower, or it could take them 10 times higher, like we saw during the raises. During central planners, right?
Yeah, right. During the COVID era, yeah, absolutely. And the case was that everything would crash and the economy would be destroyed, but because the central planners just responded by a tidal wave of money,
Yeah.
right? Everything went through the roof, as we saw. It's just crazy.
PPP and just kind of the bailouts and people not having to pay the mortgage and the student loan. I mean,
Yeah.
we forget today because we say like stimmies and we just think, oh yeah, people got a few $1,000 checks or whatever it was. But we actually forget how egregious the stimulus. It wasn't just the stimmies, for heaven's sakes. I mean, you didn't have to pay anything. You didn't have to pay your rent. You didn't have to pay. It was just crazy, crazy, crazy. So of course we had aggregate demand go through the roof. And then in addition to that, they locked everyone in a cage.
Yeah.
So you don't allow people to produce stuff. So if you don't allow people to produce stuff, if you destroy global supply chains, while you give people all this quote unquote free money and you take away the expense side of their P&L,
yeah.
What do you think is going to happen to prices?
Obviously, yeah. Obviously. So you're bearish then, right? A little bit bearish. It would be flat basically. But what happens if that happens? What happens to rents at the same time?
Well, I'd probably have to defer to you and Kenny. And I think what we were saying the other day makes a lot of sense to me, that over the short term, you're probably going to see additional supply over the next few months. But once we get past 6 months, there's no more supply coming online. That could put upward pressure on rents. My concern, though, is even if we don't go into recession, the purchasing power of the average American is declining rapidly because prices have gone up. Even if prices are only going up by, let's just say 3 or 4%, they're still going up a hell of a lot more than most people's wages. And also, you have the compounding effect. So sure, people might be making 20% more than they made in 2019, but unfortunately, their expenses are 100% higher. And that they were able to float that with all of the stuff that we were talking about earlier with the stimulus and whatnot. And I think they were able to float that with the credit card. But at a certain point, it's like you just don't have any more purchasing power. And now all of a sudden your expenses are $3,000 a month, let's say, and your income is only $2,800. So you got to go out there and Uber around and do, the gig economy thing. That works for some people, it doesn't work for other. So you kind of have the rubber meeting the road. And that doesn't necessarily lead to a huge economic collapse or anything like that in of itself. But I think that in that environment, you'd probably see more people living in the same square footage. Like their expectations, like we were talking about the other day, would probably start to decline. More people living in the parents' basement and all these things that we've seen throughout the last decade.
More roommates, more people sharing, and so forth. And I'll just show you a quick little chart here, George, that you'll maybe want to comment on.
That hits the nail right on the head.
Yeah,
exactly.
This is people are just being left behind with inflation,
Yeah. So at a certain point, that red line cannot continue to go up unless the yellow line is going up as well. And Jason, it's not just the rent, right? It's everything else.
Right.
So if your car insurance is going up, if your property taxes are going up, if your maintenance costs are going up, if your kid's school tuition is going up, if the grocery bill is going up, then that's less money that you have to go to rent that's going up at the same degree. It's not like just rent is going up, and that's the only problem that people have to solve.
Yeah. And it begs the question, what do people choose not to pay when they get squeezed? And I got another chart for you I'll show on that. And you'll definitely have something to say about this one. This is the default rates, or what's called serious delinquency. That means 90 days or more on credit cards. Auto loans, mortgages, and home equity lines of credit, and student loans. Now, student loans, I think you have to really throw out because people can't bankrupt out of those. So those don't really even count because they have different circumstances. But people can bankrupt.
Biden's paying half of them anyway, or he did pay half of them.
Yeah, so. You're right. Exactly. The government choosing the winners and losers again, unfortunately. Yeah,
but that's a great chart from the standpoint that what are people not going to pay first? It's going to be their credit card. It's going to be their auto payment. The very last thing that they won't pay is going to be food and the roof over their head.
Right. Yeah. So it's interesting, but I think this stuff does trickle over into the rest of the economy, especially those credit card bills.
Yeah, and Jason, but also I'd like to point out, look at the mortgage line right there, and look at the peak we got up to during the GFC.
Oh, it's terrible. Yeah, 9%.
Right, but I mean, think about that. It was at 1 or 1.5, and we just go up from 1.5 to 9. And that gives us the GFC. I mean, if you think back to the GFC and the whole Big Short movie and all these things, you would assume that the delinquency rate went up to 50%.
Yeah.
Something like that.
Right.
But
It wasn't that bad. Yeah.
It wasn't that bad. And we were so levered up
Yeah.
that you don't need a big move in the delinquency rate for the whole house of cards to come crashing down.
Right, because it's like you say, it's so levered up. The whole thing's just this house of cards. It's an economy built on smoke and mirrors, which brings me to another question. And I'm sure you probably read this article. Maybe you even reported on it. Our buddy Mark Moss reported on it the other day. I reported on it as well. I'm dying to get your opinion. It's been reported a lot of places, but here's the Zero Hedge article, which says, is Trump trying to push the US into a recession? I mean, I guess you could call this a conspiracy theory. What do you, I mean, look, Trump wants lower rates, right? So is he trying to get lower rates by creating a crisis?
But why does he want lower rates? He wants lower rates so the economy can grow. So I don't know that destroying the economy would achieve the objective.
Yeah.
Right. It's not just lower rates that he wants. He wants the economy. He wants to spur economic growth. So now I think there may be an argument that he's been listening to a lot of Austrians and they're like, hey, we got to get out the malinvestment. The cure for all of the insanity that we've had is actually a recession, because that flushes out all of the misallocation of resources and whatnot. It gets it all out of the system and it allows you to build from a much stronger foundation. Maybe. I know Elon Musk always retweets Ron Paul.
Yeah.
So, and then, Musk is talking to Donald Trump. And I think there is an argument for that, because if Trump does it in the first 6 months, he can always blame it on Biden.
Yeah.
And
that's a good point.
And that's another thing. He may be taking the Reagan playbook, where if you remember, when he was first elected, I think in 80 or whatever it was.
Those were tough times. Yeah.
Well, that's because Volcker intentionally created a recession by trying to take interest rates way up and restricting the money supply growth. That was their intention, to create a recession to break the back of inflation.
And it worked.
Yeah. And Reagan was like, yeah, okay. And it's, just the first quarter or the first year of my presidency. I got another 3 years left. Yeah. And so everyone remembers them as a hero. I think that's because they did it at the very beginning. And I'm sure Trump is privy to that. And they may be trying to take the same path.
Yeah, and I agree with you completely. That's exactly what I've been saying, is that, if you got to experience some tough times, you want to do it right away at the beginning, because then, number one, you can blame it on the last guy, like you pointed out. And number two, and, I think rightfully so, because Biden handed Trump a sandwich, but, you can have the rest of your term be really successful and positive and so forth.
Yeah, and I also think the tariffs are just as much about geopolitics as they are economics. Maybe more so. So I think that Trump is obviously thinking about his legacy, and he could be trying to set, all these quote unquote deals that will outlive him. And, he'll be remembered for all these great deals he got for the United States in Greenland and the Panama Canal, and, decreasing China's influence and doing all these things. And he knows that he's going to have to break some eggs to create the omelet. And so he's just trying to get that out of the way right at the beginning. I think there's a lot of variables, and there's not just one reason he's doing what he's doing. I think there are multiple reasons.
Yeah, it's a complex game for sure. George, to wrap it up, just talk about anything you want to share, a question I haven't asked you, just whatever you want to say to the listeners. By the way, before you do that, I should mention our great joint promotion. If you buy a ticket to Empowered Investor Live or Rebel Capitalist Live, you get a free ticket to the other. So this is a great promotion that George and I are doing together, and you can attend both conferences for the price of one. So empoweredinvestorlive.com or rebelcapitalistlive.com. It's a 2-for-1. You get any ticket to one conference, you get a general admission ticket to the other. So George, that's a great promotion we're having. And tell us about your conference, if you would.
Well, you're going to be speaking.
Yep.
And
I know. I have it, all of them. It's an honor.
And Kenny McElroy and a lot of my macro buddies like Jeff Snyder and Brent Johnson, Chris McIntosh, but we'll also have some people there in the freedom and liberty space, such as Robert Barnes. It's always a great group. The speakers are incredible. It's one of the few events where you really get to rub elbows with the speakers. We do these cocktail parties at night. So you're just going right up, meeting the people face to face, whether I've got Robert Kiyosaki there, Ron Paul, or Peter Schiff, or whoever it is, they're out just mingling with everyone else. And that's one of the things that makes it unique. But it's really about networking with your fellow rebel capitalists, as I say, which really just means people with a similar worldview. You can take a break from all the crazies that you're surrounded by on a daily basis, and you can come to an event where people get it and people are all about freedom and liberty and free market capitalism and just improving, their lot in life and helping other people do the same.
Yeah, good stuff, good stuff. And so we've got Empowered Investor Live coming up about a month and a half before George's event, which is Rebel Capitalist Live. They're both on separate coasts. Empowered Investor Live is in Southern California, and Rebel Capitalist Live is in Orlando, Florida. So come and join us for both of those. I think it'll be a great opportunity. But George, back to the question, anything you want to share, question I haven't asked you, just whatever you want people to know.
I would say when you're trying to figure out what's going to happen in the United States, you have to ask yourself what's happening around the world, because we are in a globally connected economy. So make sure that you watch China. Make sure you watch what's going on with Germany and the EU. China has been doing stimulus for the last, call it, year or so. Germany just announced that they're going to do stimulus. Usually these stimulus packages don't work, but we'll have to see how these play out. And then the Bank of Canada has been dropping rates dramatically. I think it's 200 basis points or so. And usually there's a pretty strong correlation between what the Fed does and what the Bank of Canada does. And then probably lastly, what I'm looking at is the 2-year Treasury yield. So that goes back to real estate investors. And if you're trying to figure out what's going to happen with interest rates across the curve, obviously you got to pay attention to what the Fed is doing. And are they going to cut 2 times this year? Are they going to cut 3 times or 4 times? Everyone's trying to figure this out. But really the Fed typically just follows the 2-year Treasury yield. And so right now, the 2-year Treasury yield is trading right around 3.95%, and Fed funds is at 4.33. And typically, if you have a chart, and they have a Fred chart of this, where the red line, I believe, is like the 10-year Treasury yield, and the blue line is Fed funds. And you just see that the red line always goes first, and then the blue line follows. And it's on the way down and on the way up.
Right.
So right now, that delta is growing between the 2-year Treasury and Fed funds, which is just increasing the probability that you're probably going to see more rate hikes with the Fed funds coming down to meet the 2-year Treasury yield. And that will likely be good for mortgage rates. But then you just got to ask yourself what the economic environment is going to be if we get those lower interest rates. And, we could get a Goldilocks scenario. We could get an economic contraction. But those are the possibilities, and you've just got to weigh the probabilities by doing your own analysis. But make sure that you're including all of that into your decision-making process. I think that's my point.
Good stuff. Well, George Gammon, thank you so much for joining us again. It's good to have you on. GeorgeGammon.com. Is that the best website for you?
Just YouTube, just George Gammon is the best to find all the stuff in the Rebel Capitalist channel.
Good stuff. Well, thanks again for joining us.
All right. Thanks for having me.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.